Why does capital flight cause balance of payments crises? Imagine a sudden rush of money leaving a country, like a flood of water draining from a bathtub. That's what happens during capital flight. When investors and businesses start pulling their money out quickly, it can cause big problems for the country's economy. The balance of payments is a record of all money coming in and going out of a country. It includes trade in goods and services, investments, and other financial flows. When capital flight happens, the money leaving the country far exceeds what is coming in. This creates a serious imbalance. People and companies often move their money abroad because they are worried about economic or political instability. They might fear the government will devalue the currency or that taxes will rise. They might also lose confidence in the country's future. When this happens, they sell assets and transfer funds to safer places. This rapid outflow of capital reduces the country's foreign exchange reserves. Foreign reserves are the money a country holds in foreign currencies to support its own currency and pay for imports. When these reserves shrink, the country struggles to keep its currency stable. As money leaves, the demand for foreign currency increases. If the country has a fixed exchange rate, the government might be forced to devalue its currency to meet the demand. When the currency devalues, imported goods become more expensive, and foreign debt payments rise. This worsens the current account deficit, which is part of the balance of payments that tracks trade in goods and services. At the same time, the capital account, which records cross-border investments, shows a large net outflow. This double whammy makes it hard for the country to pay its external debts and meet its financial obligations. Foreign investors see the crisis and pull out even more money, creating a vicious cycle. Many countries have faced this kind of crisis during times of political upheaval or economic mismanagement. When investors expect hyperinflation or default, they move their assets abroad quickly. This sudden stop in capital inflows and currency devaluation can lead to a balance of payments crisis. Governments often have to seek emergency help from international organizations or implement tough economic reforms to stabilize the economy. Capital flight reduces investment, weakens the currency, and causes economic instability. All these effects make it harder for a country to keep its balance of payments healthy. In short, capital flight causes balance of payments crises because it drains a country's foreign reserves, weakens the currency, and disrupts the flow of money in and out. This imbalance can spiral out of control, leading to a full-blown economic crisis.